Here in Australia, the impact of the recent banking problems overseas has been limited. Our financial markets are working well, and Australia's banks remain well positioned to provide the credit and the other financial services that the economy needs. Our banks have unquestionably strong capital positions and liquidity reserves well above prudential requirements. They also have very diversified deposit bases, and they carry very little interest rate risk, with APRA requiring the largest banks hold capital against interest rate risk as part of their core requirements, something that regulators elsewhere in the world have not done, and I think that should be rethought. This all means that, as APRA Chair John Lonsdale said last week, Australians could be confident that their banking system is among the strongest and most resilient in the world, with prudential safeguards above and beyond the minimum international standards. This assessment is reassuring, but it does not mean that Australia is immune to stresses abroad. While the authorities in the US and Switzerland took decisive steps to maintain confidence in the banking systems, the situation is still fragile, and recent events have put the spotlight on how rapidly shifts in sentiment can cause very large deposit outflows from financial institutions. Given this, the RBA and other members of the Council of Financial Regulators continue to be in very close contact with our counterparts overseas, and I'll be in Washington next week at the G20 and IMF meetings, which will be another opportunity to assess the situation. A second important factor bearing on the outlook is the strength of household consumption. It's increasingly clear that the higher interest rates are having a negative impact on aggregate household spending. This next graph shows quarterly consumption growth from the national accounts and our current estimate for the March quarter. As you can see, consumption growth has slowed very considerably from the fast rate that was evident during the bounce back from COVID, and consumption growth is now quite a lot below average. Looking forward, we expect that consumption growth will remain subdued for some time, but there are uncertainties here and there are factors pulling in both directions. On the positive side of the ledger, unemployment is low and households in aggregate saved a lot of extra money during the pandemic. The unemployment rate is the lowest that it's been since 1974. That's nearly 50 years ago. And as you can see in that chart, underemployment is also at a multi-decade low. People are finding jobs, there are plenty of job vacancies, and people are finding the hours of work they want. This is good news, and it's one of the positive legacies of the pandemic. Inflation's another legacy of the pandemic, but low unemployment is one of the legacies of the pandemic as well.